Stop using a calendar to predict a currency collapse. You've probably seen the theory, a predictable 250-year cycle that supposedly dooms every great power and its currency. And according to this historical timer, the US dollar is next. It's seductive because it organizes chaos, debt, politics, grocery prices, into one clean story: destiny. A clock is ticking. And if you're wrong about why currencies fail, you'll buy the wrong protection. People point to Rome, Spain, Britain, connect the dots to one number, 250, and call our moment the age of decadence. It feels right, which is exactly why it spreads. Right now, thousands of investors are making real money decisions based on a theory that says every great empire collapses after roughly 250 years. And that means the US dollar is next. And if that theory is wrong, people are positioning their entire financial future around a historical myth. Here's the uncomfortable truth. Currencies don't collapse because of time. They collapse because something breaks. And when currencies actually fail, it's not an academic cycle. It's savings freezing, buying power collapsing, and retirement plans getting rewritten. So today we'll do two things. First, I'll show you why the 250-year theory doesn't hold up. Second, I'll give you the real checklist professionals watch. By the end, you'll know what actually matters, and what's just internet noise. If you care about what actually breaks, not what trends, this is for you. Just to show you what I mean, Rome doesn't even fit this cycle unless you cherry-pick the start date. The Ottoman Empire lasted over 600 years. The pound's time as the uncontested center of global finance was far shorter than 250 years. So the number works only if you force it to. So, where did this idea even come from? A lot of it traces back to a British diplomat named Sir John Glubb. He looked at history and saw a pattern, a kind of predictable lifespan for great nations that lasts about 250 years. He called the final, grim stage the age of decadence. More recently, investor Ray Dalio supercharged this with his big cycle theory. Then, the internet poured gasoline on it. And here's why the idea is so powerful. It takes a messy, scary reality, debt, politics, inflation, and turns it into a clean story with a simple countdown. But this is where the danger comes in. If this idea is wrong, investors may prepare for the wrong type of crisis. Serious investors don't just study history, they study failure mechanics. The narrative is the 250-year clock. The reality is that currencies don't have birthdays. Let's be clear, a calendar is not a cause. It's just horoscope math. The story goes something like this. The United States was born in 1776. Add 250 years, and you land smack dab on the year 2026. According to the theory, the symptoms seem to fit. Debt, division, a currency being printed into oblivion. The conclusion feels inevitable. But history is never that clean. It's messy and full of exceptions. When you actually look at the data, the entire 250-year foundation just crumbles. It's not a slight miscalculation. It's a fundamental misreading of how great powers and their currencies actually fall. The truth is, there is no magic number. There is no timer. Empires don't fall because their time is up. They fall because of specific, identifiable failures. And ignoring those real reasons to focus on a myth is like hearing a rattling in your car's engine and checking your horoscope for an answer instead of just looking under the hood. So, let's pop the hood. To really debunk this myth, we need to take it apart piece by piece. The theory stands on three pillars: that empires have a consistent 250-year lifespan, that this cycle also applies to their currency, and that the modern US is just like these old empires. All three of these pillars are built on sand. Pillar 1. The timelines are an illusion. First, let's talk about the number itself, 250. It sounds so precise, but it only works if you get really creative with historical dates. Proponents have to bend, stretch, and chop up history to make the numbers fit. Let's start with their favorite example, the British Empire. The theory says its dominance lasted about 250 years. Okay, but when do you start the clock? Do you start it in the early 1600s with the first colonies? What about 1707 with the creation of Great Britain? Or maybe after 1815, when Britain was the undisputed global powerhouse? And when did it end? Was it after World War I, when the country was broke? Or 1947, with Indian independence? Depending on which dates you pick, you can make the British Empire last 150 years, 250 years, or over 300 years. The pound did become the dominant currency during Britain's peak era, but the period where it was truly the unquestioned center of global finance was much shorter than people think. By the early 1900s, the US was already rising fast, and the two world wars accelerated the handoff. The key point: reserve currency transitions are messy, political, and based on balance sheets, not birthdays. And what about other empires? Rome? The Roman Republic lasted for almost 500 years. The Roman Empire in the West lasted for another 500. The Eastern Roman Empire then went on for another 1,000 years after that. So which 250-year slice are we supposed to look at? The Spanish Empire's peak power lasted about 150 years before it entered a long, slow decline. The Ottoman Empire lasted for over 600 years. The 250-year cycle isn't a historical reality. It's a just-so story, made by picking a few convenient examples, ignoring all the ones that don't fit, and using vague start and end dates to make the math work. It's numerology, not history. And here's the scary part. The real risks don't announce themselves with a countdown. Here's the punchline. If your model only works when you pick the dates, it's not a model. Pillar 2. Correlation is not causation. Why empires really fall. Okay, let's pretend for a second that the 250-year timeline was accurate. The theory's next fatal flaw is assuming that time itself is what causes the collapse. Let me make this brutally simple. Time isn't a cause. It's just a background. This is a classic logical mistake. Just because your rooster crows before the sun rises doesn't mean the rooster caused the sunrise. Empires don't fall because an alarm clock goes off. They fall for specific, concrete, and often self-inflicted reasons. Let's look at the real causes. Rome didn't just fall because it got old. The Western Roman Empire collapsed under a mountain of very specific problems. It had a severe financial crisis driven by constant wars and out-of-control military spending. Its economy was crippled by an over-reliance on slave labor, which dried up when the conquest stopped. The government kept debasing its currency, leading to runaway inflation. On top of that, you had crushing taxes, insane political instability, with emperors being murdered one after another, and deep corruption. Add in constant invasions and the logistical nightmare of running a huge territory, and you have a recipe for collapse. It wasn't a cycle, it was a systems failure on every single level. What about the Spanish Empire? Its decline wasn't about a timer. It was about catastrophic economic mismanagement. Spain got fabulously rich from the silver and gold it took from the Americas. But instead of using that wealth to build a productive economy at home, the flood of silver caused massive inflation that crippled its own industries. The money was squandered on endless, pointless wars across Europe. The government went bankrupt over and over, and its rigid economic policies got smoked by more nimble rivals like the Dutch and English. Spain didn't invest its windfall, it spent it. When the silver started to run dry, the whole house of cards came down. And the British Empire? The pound didn't lose its top spot because its 250th birthday arrived. It lost it because of 2 world wars. Britain basically bankrupted itself fighting Germany, selling off its assets, and going deep into debt with the United States. By the end of World War II, the US had most of the world's gold, a massive industrial economy untouched by war, and was the world's biggest creditor. Britain was a debtor. The shift from the pound to the dollar wasn't mystical. It was just a recognition of the new economic reality. The US was the only country left with the strength to anchor the whole system. In every case, the cause of decline wasn't a date on a calendar. It was a cocktail of fiscal irresponsibility, military overreach, and economic mismanagement. Those are the real lessons of history. Notice what's missing. None of this is time. It's spending, debt, war, and trust. Pillar 3. The modern world is radically different. The final nail in the coffin for the 250-year theory is the assumption that the 21st century United States is anything like 17th century Spain or 4th century Rome. The entire structure of global power and money has fundamentally changed. First, today's economy is interconnected in a way that was literally unimaginable back then. The US dollar isn't just America's currency, it's the plumbing for the entire global financial system. The vast majority of international trade and oil sales are priced in dollars. It's what central banks around the world hold as their savings. A sudden collapse of the dollar wouldn't just hurt the US, it would trigger a catastrophic worldwide economic depression. This creates a powerful incentive for everyone, even our rivals, to prevent a chaotic collapse. It's basically a policy of mutually assured financial destruction. Second, power itself has changed. It's not just about the size of your army anymore. The US projects power through its tech, its culture, and its network of alliances. Plus, nuclear weapons have made the kinds of giant, territory-grabbing wars that exhausted past empires far less likely. Third, and this is a big one, there's no clear alternative to the dollar right now. When the pound declined, the US dollar was waiting in the wings, a currency from a bigger, more dynamic economy. Today, there's no such heir apparent. We'll get into this more in a bit, but neither the euro nor the Chinese yuan has what it takes to fully replace the dollar. Trying to apply a simple cycle born from observing pre-industrial empires to today's complex, globalized world is a huge mistake. It's like trying to navigate a superhighway using a 16th century sailor's map of the stars. The roads are different, the car is different, and the rules are entirely new. The 250-year cycle is a myth. But, and this is the most important part, that doesn't mean the dollar is invincible. So, if the 250-year cycle is a dangerous distraction, does that mean the dollar is perfectly safe? Absolutely not. The real threats to the dollar are far more complex and far less predictable than a simple timer. They aren't a ghost in the machine. They're a concrete checklist of economic and political triggers. Forgetting the myth lets us focus on reality. And the reality is that there are powerful forces at play that could, over time, erode the dollar's top spot. These aren't secrets. They are publicly visible trends that smart money and central bankers are watching very, very closely. It's time we all learn to watch them too. Now we switch from internet theory to the dashboard that actually moves markets. So what would it actually look like, in real time, if the dollar were truly losing its grip? Instead of looking at a calendar, this is the dashboard of key indicators that serious people are watching. These are the 5 real triggers that could genuinely challenge the US dollar's status. Trigger number 1, a catastrophic loss of trust, the confidence game. At its heart, all modern currency is a confidence game. A dollar bill has no real value on its own. It's valuable because we all believe it is. More importantly, we believe the US government will stand behind it. The single biggest threat to the dollar is anything that shatters that confidence. This isn't about day-to-day political drama. It's about a fundamental loss of faith in the US government's willingness to pay its bills. The most obvious warning light here is the national debt. For decades, US Treasury bonds have been seen as the world's safest place to park money. Countries and companies hold them because they believe, with almost total certainty, that the US will always pay them back. What could shake that faith? One scenario is a self-inflicted crisis over the debt ceiling, where politicians play chicken and bring the US to the very edge of default. Even if they swerve at the last minute, the repeated drama of using America's credit score as a political bargaining chip damages its reputation for stability. It introduces a risk that was never supposed to be there. Another path is a slow burn crisis, where the debt just keeps climbing without any believable plan to get it under control. If global investors start to think the only way out is for the US to print tons of money and inflate its debt away, they'll start demanding higher interest rates. That could create a vicious cycle. Higher interest rates make the debt more expensive, which makes the deficit bigger, which requires more borrowing, which spooks investors and drives rates even higher. Trust is everything for a reserve currency. A severe and lasting loss of confidence in America's political and fiscal stability is the most direct threat on this checklist. Trigger number 2, the rise of a viable alternative. The dollar is king in large part because there are no convincing challengers to the throne. It's the Tina principle. There is no alternative. For any currency to take the dollar's crown, it can't just be good enough. It has to be overwhelmingly better in a few key ways. A true global reserve currency needs a massive, deep bond market. Central banks need a safe place to park trillions of dollars that can be bought or sold instantly. The US Treasury market is, by far, the biggest and most liquid in the world. Open capital flows. Money has to be able to move in and out of the country freely without the government's permission. The rule of law. Investors have to trust that their assets won't be seized or that the rules won't be changed on them overnight. A huge, dynamic economy. The currency needs to be backed by a big slice of the world's economy and trade. With that in mind, let's look at the contenders. First, the euro. The Eurozone is a huge economy, and it's the world's number 2 reserve currency. But it has a critical, maybe even fatal flaw. It's a currency without a country. There's no single government backing it. The European Central Bank controls the money, but various different governments control the spending. This means there's no unified, safe asset, like a US Treasury bond. Is German debt the safe one? Or Italian? This lack of a unified bond market severely limits the euro's appeal. Until Europe solves this problem, the euro will stay a distant second. Next, the Chinese yuan. China is the world's second biggest economy and a top trading nation. So on the surface, it looks like a natural challenger. But the yuan fails on almost every other count. China has strict capital controls, so money isn't free to move. Its exchange rate is tightly managed by the government. And most importantly, it lacks the rule of law and transparency global investors demand. Would Brazil or Saudi Arabia feel comfortable holding most of their nation's savings in assets that could be frozen at the whim of the Chinese Communist Party? For now, the answer is a hard no. The dollar stays on top not just because of its own strengths, but because of the deep weaknesses of its rivals. A serious threat would require either Europe to radically integrate or China to completely change its entire political and economic model. Neither seems very likely anytime soon. Most people argue politics. Serious investors watch settlement, trust, and liquidity. Trigger number 3, runaway hyperinflation. Lots of people who fear a dollar collapse point to rising prices as proof the end is near. But it's really important to know the difference between the painful inflation we've seen lately and true currency-destroying hyperinflation. High inflation, like 5 to 10%, is bad. It wrecks your purchasing power and creates uncertainty. But hyperinflation is a totally different animal. Hyperinflation is usually defined as prices rising by more than 50% per month. This is the stuff of nightmares. Germany in the 1920s, where people used wheelbarrows for cash, or modern Zimbabwe with its $100 trillion bills. Hyperinflation isn't just an economic event, it's a psychological one. It's a total collapse of faith in the currency. People spend money the second they get it because they know it'll be worth less tomorrow. They don't save anymore. They sprint to the store before prices change again. This death spiral is almost impossible to stop. Could this happen in the US? It's an extremely low probability event. First, the US has an independent central bank, the Federal Reserve. The Fed's main job is to keep prices stable, and it has the tools to fight inflation, even if using them causes a recession. Hyperinflation usually happens when a government completely hijacks its central bank and forces it to print money without any limits. Second, the US can, technically, never go bankrupt because it can always print the dollars to pay its debts. The real danger, as we talked about, isn't failing to pay, but paying people back with worthless, devalued dollars. For the US to hit hyperinflation would require a complete political breakdown and a collapse of our entire economy. It's not impossible, but it's a universe away from our current problems. If this is useful, subscribe. And if you want to help this reach more people without clickbait, you can use your weekly YouTube hype next to the like button. Trigger number 4, the end of petrodominance, the petrodollar system. This is one of the most talked about and misunderstood threats. The petrodollar system isn't a currency. It's just an arrangement from the 1970s where major oil producers, like Saudi Arabia, agreed to sell their oil only in US dollars. This simple deal created a massive, permanent global demand for dollars. Any country that needed oil had to get dollars first. In turn, the oil nations ended up with huge piles of dollars, which they recycled by investing them back into the US, mostly by buying treasury bonds. This helped fund the US government and keep our interest rates low. So, what could threaten this cozy setup? First, major producers could start selling oil in other currencies. We're already seeing hints of this. Russia is selling oil to China and India in Yuan. There's been talk that Saudi Arabia might start accepting Yuan for its sales to China. While these are small steps, a big move by OPEC away from dollar-only pricing would be a significant blow. It would reduce that automatic global demand for dollars. Second, a long-term global shift away from fossil fuels to renewables would naturally make the petrodollar system less important. If the world runs on solar and wind, the system of pricing one specific commodity in dollars becomes way less central to the global financial order. The end of the petrodollar system wouldn't kill the dollar overnight, but it would remove one of the key pillars that has propped it up for 50 years. It would level the playing field. This is a slow-moving trend, but it's one of the most important ones to watch over the next few decades. Trigger number 5, a black swan, geopolitical or technological event. The final trigger is the one we can't predict. A black swan is an event that comes out of nowhere and changes everything. The fall of the British pound was sped up by 2 world wars, black swans of their time. What could a modern version be? It could be a major global conflict that completely reshuffles the world order. Or it could be technological. Think about digital currencies. While Bitcoin is too volatile to be a reserve currency now, the tech is still young. What if a future technology emerged, a decentralized system backed by a group of nations, maybe, that offered a more stable, transparent, and neutral way to settle trade? That kind of invention could make our current system look ancient. This trigger is a reminder that we can't predict the future. The biggest shifts in history are often driven by things nobody saw coming. It's a call for a little humility and a recognition that no system is permanent. This checklist, loss of confidence, a viable alternative, hyperinflation, the end of the petrodollar, and a black swan, is a much more realistic way to think about the dollar's future than any mythical cycle. So, what's the rational way to act in this environment of fear and uncertainty? It all comes down to focusing on what you can control and tuning out the noise. First, let's talk about what not to do. The worst thing you can do is make huge financial decisions based on panic, especially when that fear is being peddled by people trying to sell you something. The internet is full of doomsday prophets who use the 250-year cycle to sell you gold and silver. Now, there's nothing wrong with owning precious metals as a small part of a portfolio, but the alarmist marketing that pitches gold as the only thing that will have value after a total dollar collapse is just wrong. They prey on your anxiety to sell overpriced products. In finance, simple answers are almost always the wrong ones. Don't liquidate your life savings to buy a bunker full of gold bars because a YouTuber told you a historical clock is about to run out. So, what should you do? The answer is frustratingly boring, but it's also the proven path to building and keeping wealth. First, diversify. It's the oldest rule in the book for a reason. Don't put all your eggs in one basket. That means diversifying across different assets like stocks, bonds, and real estate, across different countries, and even across different currencies. A diversified portfolio is your best defense against a future you can't predict. Second, focus on value. Instead of chasing hype or reacting to scary headlines, invest in productive assets. Own shares in well-run, profitable companies that make things people actually need. Own real estate that generates income. These things have intrinsic value that isn't tied to the daily whims of the market, and over the long term, they tend to grow faster than inflation. Third, manage your debt. The best way to make yourself resilient to economic shocks is to minimize your own debts. High-interest debt makes you fragile. Paying it down is one of the best, lowest-risk investments you can possibly make. And finally, think in probabilities, not certainties. The future isn't one set path. It's a range of possibilities. A dollar collapse is a low probability, high impact event. It is not a sure thing. Your strategy shouldn't be to bet everything on that one outcome. You should build a financial life that is tough enough to handle a wide range of futures. Smart investors don't watch the calendar. They watch the checklist we talked about. They monitor the debt situation, keep an eye on rival currencies, and stay informed on global trends. But they don't panic. They use that information to make small adjustments, not to make wild all-or-nothing bets. They understand that the decline of a reserve currency, if it happens, is almost always a slow, multi-decade process, not something that happens overnight. The idea of a 250-year cycle that dooms the US dollar is a piece of historical fiction. It's a great story, a tidy narrative that seems to make sense of a chaotic world. But it's built on cherry-picked data, bad logic, and a failure to understand how our modern world actually works. It survives not because it's true, but because it's simple, and it confirms our anxieties. By debunking this myth, we're not saying the dollar is invincible, or that the US has no problems. It's the opposite. The very real threats, spiraling debt, political dysfunction, and strategic rivals, are far too important to be ignored. The danger of the 250-year myth is that it distracts us. It has us looking for ghosts in history books instead of focusing on the real-world economic dashboard right in front of us. The fall of a great power's currency is never about destiny. It's about choice. It's the sum of thousands of decisions made by leaders and citizens over decades. It's what happens when you fail to manage your finances, fail to invest in your strengths, and fail to keep the trust of the world. This is one of those topics that's easier to explain by walking through it. So if someone you know is stuck on the 250-year story, this will help. History doesn't give us a timeline. It gives us a series of case studies, warnings about what happens when you ignore the real problems. Our task isn't to fear a mythical clock, but to have the clarity to see the real challenges and the courage to demand they be fixed. The future of the dollar won't be decided by a 250-year-old story, but by the choices we all make today. Price is loud. Plumbing is real. Be the person who watches what breaks.